Welcome to Basic Option Strategies. I'm Danielle Shay and I'm the VP of Options at Simpler Trading. There are so many options when selecting option strategies. Where should you begin? It all starts with what your overall goal is, and that really begins with your speculative bias. Options at the end of the day are a speculative leverage tool in the stock market. So, how do you want to use them? Are you trying to speculate on which direction the market goes? Do you want to just bet on sideways action or purely bet on the rise and fall in volatility without care for the overall price direction? Let me explain. In options trading, you can make trades in a directional, neutral, or volatility based strategy. So, which one will you choose, and what do you think is right for you? At the end of the day, traders can pick one or all three of these strategies. At this point in my trading career, I like to mix and match quite a bit, though I can say that I started out purely as a directional trader. So, what's the difference and why would you choose one or the other? Let's start off with directional trading. Directional traders attempt to capitalize on up or down movements in price on the underlying. That would mean, for example, they are looking at Microsoft stock and they're betting on Microsoft trading higher, and they would like to have an option strategy that can help them capitalize on that kind of price movement. What about a neutral or income trader? These kind of traders attempt to capitalize on options by using sideways price action. Why would someone want to do that? Well, that's because the market is not making moves all of the time. We have big directional moves that will occur. And of course, it's amazing and great to capture those kind of moves. But a lot of the time, the market's consolidating and it's chopping back and forth. So, as options traders, we have a unique opportunity here where we're able to actually take advantage of that sideways price action if you know how to do it. That's exactly what neutral or income traders will do. What about volatility traders? Volatility traders attempt to use options to profit from changes in volatility, regardless of the direction and price of the underlying. Now, this is something I've really come to love over the course of especially the past few years. And that's because when you're using these kinds of strategies, the actual price direction doesn't matter as much, and you can trade the rise and fall in implied volatility. This is also something unique to options trading that you really can't do if you're just trading stock. So, when you're looking at these three strategies, I like to use a combination of all three, but I especially love using neutral trades and volatility trades because this is something unique to the options market that you just really can't do if you're only trading stock. So, let's go ahead and talk about each one and think about it as we're going through which area you'd like to focus in. Now, most people will get into options trading because they're enticed by the directional moves. That's exactly what I did, of course, and those moves are great. But we'll talk about each of them as we continue throughout the presentation. What's the objective in directional trading? This is to capture and profit when an underlying makes a directional move from one price to another. Here are a few key characteristics. This kind of strategy is price focused. Directional strategies often revolve around the idea that the price of the underlying will make a big move in the speculated direction. Common strategies include calls, puts, debit spreads, and butterflies. The risk to reward can be really amazing depending on what kind of strategy you're using. It typically has potential rewards that are pretty substantial if the direction and price targets are identified properly. What about neutral trading? The objective with neutral trading is to profit from an underlying asset that remains within a specific price range or exhibits minimal price movement over a period of time. Now, why would a trader want to do this? Well, it's because the market doesn't make big moves all the time. While it's amazing and fun to capture huge directional moves in Tesla or Apple or Chipotle, those big moves aren't occurring all the time. In fact, there can be several months in a row, perhaps, where the indexes don't make a lot of moves because they're consolidating. When this occurs, it's great to have other tools in your toolbox, such as being able to trade in a neutral manner. These kind of strategies often revolve around the idea that the price of the underlying is not going to move significantly in any direction. Common strategies include iron condors, butterflies, and calendar spreads. These kind of strategies are typically going to have a defined risk and reward, and they're going to aim for consistent but often smaller profits than what you'd see with something like directional trading. The reason why this is so enticing is because it's really not something that you can do if you're simply buying and holding or trading stock. Because of the way that options function, this is something that's very unique to the options market, and it really enables you to have a strategy that you can use when the market is just trading sideways. What about volatility trading? Options are again also unique because you can trade simply the changes in implied volatility because of the fact that implied volatility is a core component of options pricing. So, how would one do this? Well, these strategies are based on prediction about the future volatility of an asset, but not necessarily its price direction. The volatility can be historical or it can be implied. You can do this using straddles, strangles, Vega based trades, also by using iron condors and iron butterflies. Both buying and selling the options can be used to exploit different volatility conditions. One of my favorite times to trade volatility is surrounding earnings. This is because volatility is always going to rise going into an earnings report, and it's always going to fall after an earnings report. And that's going to happen independently of the price of the actual underlying stock. Now, of course, the price of the underlying stock moving as well is going to have an additional impact. But you can trade volatility and volatility alone surrounding earnings reports. I also really like this kind of trading because the risk to reward can be really good. Again, it just depends on how you set up your trades. Typically, on my volatility based trades, I'm going to risk one to make about two. So for me, that is a great risk to reward scenario. We talked about a few of these strategies when we discussed directional trading, volatility trading, or neutral trading. So, what are some of the top options strategies? Well, here's my top list of option strategies that we use here at Simpler Trading. Covered calls, long calls, puts, call debit spreads, also known as a bull call spread, put debit spreads, also known as a bear put spread, put credit spreads, call credit spreads, butterflies, unbalanced butterflies, straddles, strangles, iron butterflies, iron condors, calendar spreads, and call. Now, varying traders may use different strategies for either directional, neutral, or volatility purposes. So just keep in mind when I'm going through this presentation, I am primarily talking about the way that I use these strategies because they are something that can really be personalized, right? For me personally, I use butterflies as a directional strategy, but I know a lot of people use them as more of a neutral income based strategy. So just keep that in mind that as I'm going through this, I'm talking about primarily how I and a lot of the other traders at Simpler Trading use these strategies. Now, we talked about a variety of different spreads, right? But let's go ahead and talk for a minute. What is the difference between a single option and then a spread? Okay. So, generally, when people get into options trading, they're going to start with just single options. What is that? Well, a single option is going to involve just one options contract. Say, for example, if I buy just a put or just a call. Now, it's really common that people will come to simpler trading and they say, oh my gosh, why are you guys doing spreads and butterflies? This is so complicated. I just want to do puts or calls. And what we strive to do is we strive to explain and demonstrate why we use spreads so much more frequently and how much more beneficial they are to you. So, you know, when you're looking at the risk to reward, okay, let's just start off with that. When you're buying a single option, it does have a defined maximum risk, all right? Because you have a debit that you're paying to get into a put or a call. So that defined risk is great, right? And what's really great about it is that the profit potential is really unlimited. So let's say, for example, you buy, I'm going to use Microsoft as an example again because I used a lot of the slides as an example for Microsoft to stay consistent. But Let's say you buy a long call on Microsoft and, you're hoping that it trades 5 to $10 higher because that's where you have your technical analysis targets and you have a solid setup, okay? But then let's say that they announce some amazing news and the stock actually gaps up $50, okay? You can crush it with a long call. That's a situation where, your rewards would just be absolutely phenomenal. But how often does that really happen, right? It could happen every now and again. But what's the likelihood that a random news announcement happens and you just have this major move? It's much more likely that you're going to be regularly trading directional setups over time and you want something that's going to give you a good cost basis, a good risk to reward, and more than anything, it's going to bring down your overall cost when you're regularly trading in the options market. And so that's why we're generally going to use option spreads, even though they're going to limit your potential, okay? Because it's one of those things where it's, are you a trader? Are you day in and day out trading over a span of months, over a span of years, or are you a gambler where you're coming into the options market and you're saying, hey, you know what? I'm going to put a crazy amount of risk on this one stock with long calls because it's a lotto ticket. That's, kind of the difference between doing it day in and day out and sometimes when people come into the options market and they just want, a one hit wonder. So we are going to use long calls and puts, when the situation presents itself. But overall, the reason why we use spreads is because of the way that they work. Okay. So a spread is going to involve two or more options contracts, and the contracts can be a combination of puts and calls. They're typically going to be on the same underlying asset with the same expiration date and different strike prices. It can be a different expiration date if you're using something like a diagonal. But for the most part, a lot of the spreads that we're going to do, they're going to have the same expiration date. The risk to reward on these are going to define your maximum risk and they're also going to define your maximum reward. But the reason why they're good is because of the numbers. Okay. I'm always going to prefer spreads to single options like long calls. And it's because through spreads, I can cut down my cost basis by around 50 to 75%. When you're trading, day in and day out, that's huge. Um, and it can also improve my risk to reward substantially. When you say improve your risk to reward, that can be confusing because you say, well, Danielle, you just said that what if Microsoft caps up, $50 overnight and you had a long call, you could crush it. But if you had a debit spread, your profits would be capped. So why would you do that? It's because of the way that the numbers play out. So in general, when you're trading with a long call, you're generally going to risk one. So one would be whatever the debit paid. Let's say you paid $5. On a regular basis, using technical analysis targets, my profit targets are generally going to be about 25 to 50% of the debit paid on a long call. Okay. Can you get more on a random experience? Yes, you can, of course. But with a butterfly, your debit is going to be cut down, 50 to 75%. So instead of paying $5, maybe you're paying $2.50. Maybe you're actually paying $1.75. Um, and you're risking one to make about 50% of your debit up to around 300% of your debit. So for me, this was especially enticing when I was a beginner options trader. I didn't have a lot of money to deal with. It was really hard for me to sit through volatility, which the volatility is absolutely bigger when you're looking at a long call versus a spread. You're going to see your P&L moving a lot more than you will with a spread. So that can be harder as a beginner trader as well. And it can cause you to, get out of a trade. Let's say you got into a trade and it's moving around and you're getting a little panicky, and you get out and then the huge move happens. Well, that's no fun, right? So When you get into a trade and you're waiting for it to play out, generally the butterflies and the spreads are going to be a little bit more forgiving. They're not going to have as big of outsized moves in the beginning when you first get in and the market's just kind of chopping around. But most of all, I really like that you can spend less money and your risk to reward is going to be better. That is because this gives me better leverage on my money, and it's also allowed me to trade options with a small account. But I also really like how they can last better through volatility. Now, you also might say, well, oh my gosh, I'm just doing calls or I'm just doing puts. How do I get there? This is the order that I think is best to learn these strategies in. I think, starting with calls and puts, after that, learning debit spreads is really with the spread, all you're doing is you're just adding another leg. After that, you can either learn credit spreads or butterflies. Butterflies would just really be the next spread and the next step after a spread trade. But it's really a combination between a credit and debit spread. So I think if you go calls, debit spreads, credit spreads, butterflies, that's going to make sense as well. So when we're talking about options and spreads and single options, you also have to keep in mind that in the options market, you can also be a buyer or a seller. So if you're a buyer, um, options buyers are going to be paying a debit to control the long option until expiration. They're buying the right to purchase a stock at a certain price in a way that limits the risk. The goal is to utilize leverage to profit on a move in the underlying. If you're a seller, the option sellers are going to sell options to collect premium. They take on the obligation to sell the underlying equity to a buyer if the buyer decides to exercise their option. The goal is to sell options that will lose value so they can profit. Options are bought or sold depending on the purpose and the goal for doing so, along with the style of the individual trader. Traders may be attempting to capitalize on direction, burn premium through a neutral trade with premium decay, or be simply trading the volatility. What is the difference, right? The difference really just depends on what you're trying to do. Generally people get into directional trading because it's exciting. And then as they learn more about the market and learn more about trading, especially about options, selling premium can be very enticing, especially if you're looking for something that's a little bit more boring. And then as you get into understanding about how earnings season works and understanding that, you know, directional trading isn't the only thing out there, and you can actually trade volatility without as much care as to what the price is doing, that can be really exciting as well. So I think that all three of these methods of trading options are great. I do all three personally. It's really just going to depend on your style, goals, and risk tolerance. So as we go through the rest of these slides, just keep that in mind. I'll be talking more about directional strategies and how I use calls, puts, debit spreads, and butterflies. I'll also be getting into premium selling strategies. Then we'll talk a little bit about volatility as well. There's also a specific section within Simpler Essentials that is purely volatility based off of earnings. So make sure you check out that one as well because that is where we're going to be covering the volatility strategies. Directional strategies. I love directional trading setups. To trade these by buying options, I primarily use long calls and long puts, debit spreads, and butterflies. To capitalize on directional setups in the most effective manner, I generally enter trades for a debit because this offers the highest profit potential. Remember, the goal of trading in a directional manner is to get involved at a specific price and to get out at a higher price after the underlying moved in the direction that you speculated. You can also trade these moves by selling premium. But during this section, we will talk about purchasing options because it is typically the first step and has the most enticing profit potential. Note, we will cover more conservative premium selling strategies later on. Options and leverage. One of the primary reasons traders are attracted to options is the leverage they offer. A small premium investment can control a much larger amount of the underlying asset. This means that even a modest move in the underlying's asset price can yield significant percentage gains on the option's price. Trading the up and down moves. Directional trading with options isn't just about betting on market rises. Traders can also profit from falling markets by using bearish option strategies, giving them tools for any market forecast. Here's an example of a directional chart. Here we're looking at NVIDIA on a weekly time frame. As you can see, NVIDIA has made some pretty big moves. Starting right about here, you can see that you had, for months, really over a year of downward price action. NVIDIA fell all the way to $108 a share before the trend reversed and shifted to the upside. At that point, you can see this pretty big directional move with a huge volume increase right here, all the way up to $502 a share. Now, NVIDIA has been a really great trading vehicle, especially in the options market, has a lot of volatility. It's a high beta stock, generally makes some pretty big moves. So, this is a great chart to use as an example because, I mean, you can clearly see how it's made some pretty big directional moves, and you can imagine the ways in which traders would be able to capitalize on these moves, either up or down. When you're looking at ideal tickers to trade in the options market, generally, sticking with tickers that are in a trend is going to be a little bit easier. A lot of people will try to trade names that are on forums or in the news. And, a lot of these names can be highly volatile and they're not really in a trend. They're just kind of moving based off of news related reactions. Those can be pretty challenging. So I usually tell our traders that you want to look at tickers that are in a longer term trend like this. Doesn't really matter if it's up or down. You just want to find a trend that you can stick with. Generally, something that's popular, has high liquidity, and if it has high volatility as well, it can be really helpful in the options market. So there's certainly many tickers that are better than others when you're looking at directional strategies. And using this chart pattern as an example, it's one that has a really strong longer term trend patterns, which makes it a great candidate for directional trends. Now, here's another example of another chart that's been in a really strong trend. This is going to be Meta. Now, you can see that there was a really great trend over here. You can tell it's in a trend because it has these stacked moving averages. You have these candles that are holding right up above these key moving averages. And then you say, oh, well, what happened right here? Well, it pulled back and it's been consolidating. So ever since about August 14th, maybe a little bit earlier, beginning of August, you can see that that trend kind of rolled and we've been just in this consolidation state. So you might say, well, is that one good for a directional strategy? In my book, yes, it absolutely is because it had a previous bullish trend. It's pulled back, it's been consolidating. When it's in consolidation, and you can also see that we have a squeeze setting up, that means that that energy is building up and it's getting ready to take off. So, typically when you have a squeeze after you've had this really nice bullish trend, and then you also have an earnings report coming up, that's going to be a great time to speculate on a continuation of the trend to the upside. So that's why I like this one for a potential directional strategy right here. Now, you might also say, well, Danielle, I mean, it sounds easy following the trend, but the trend is only your friend until it ends, right? So what do you do? Well, yes, that's absolutely true. The trend is your friend until it ends. But that's the thing about the trend is that you can ride it until it ends. And using your technical analysis and your tools, you'll be able to notice when the trend starts to shift. Now, inevitably, if you're, buying the dip every single time it dips, there's going to be some time where it doesn't just rally, right? And it does shift. That's just part of it. It's part of being a trend follower. You can't buy the dip forever and have it work every single time. There's going to be a time where the trend shifts. On this chart, you can see that you have these really nice green candles, really nice stacked moving averages. They shift from green to yellow to red, and then you see how they break down right here.
You have high volume selling. Now you have all these resistance zones above your candles. That's where you got a trend shift. So, a directional trader can say, hey, you know what? I've been following this trend. Okay, the trend is broken. Now we're in a downtrend. So that's something that you can do with options. That you can't really, I guess you could do it if you're trading stock, but if you're just buying and holding stock, you can't really do it in the same way that you can do it in the options market where you can ride the trend up, trend shifts, then you can ride the trend down. So, directional trading can be done on any time frame. Traders will ask me all the time, "Well, how long do you stay in a trade?" And the thing is that I'm not a day trader personally. I have little kids. I find it, something that you need to be attached to screens for, and it just doesn't really work for me with my family life. So I prefer to swing trade, but it's absolutely possible to use these setups on, a short time frame chart, like 5-minute chart, and be in and out of trades in 30 minutes or less. For me, as I mentioned, it's not really my style. So I like to use, daily and weekly chart patterns. I'll also use 195-minute chart, a 78-minute chart. These are really good swing trading time frames. So that is what I like to use. Directional strategy flexibility. Options provide multiple ways to profit from directional moves. Bullish traders can buy calls or sell puts. Bearish traders can buy puts or sell calls. And for those who are moderately directional but also want to benefit from premium decay, spreads like bull call spreads or bear put spreads can also be utilized. In conclusion, while directional trading with options offers many advantages, it's essential to be aware of the risks. The leverage that can amplify gains can also magnify losses. That's why you have to know what you're doing. Options also have a time component, which means that they will lose value over time, impacting a trade's profitability. As always, proper education, risk management, and strategy evaluation are crucial for anyone looking to engage in directional options trading. During the next section, we will discuss using calls and puts for directional trades. See you in the next episode.